Good morning, everyone, and welcome to the Ankerstar Wealth Market Update. I'm your host, Allison Ankerstar, and today we'll be talking about the documentary called Diamond Hands, the long-term thesis against investing in oil and advanced option strategies regarding LEAPS. But before we begin, as a reminder, this is financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. You watched Diamond Hands last night, the documentary detailing the rise and fall of GameStop. What's your take?
Well, good morning, everybody. And I first have to say that today is a first as far as all the topics we have this morning came from clients, right? So they came from two clients, but thank you for your questions. Certainly, I'd like to talk about things that are more important to you than what I think are out there. So if you have your questions, again, submit them, please, to me, to us somehow, and we'll go from there. Okay, this documentary, Diamond Hands, it is horrible at the beginning. It is like and I will say the whole thing is like a bad Saturday Night Live skit. And I like Saturday Night Live, but they certainly have their misses as far as not all of their content's amazing. But this one's rough. Now, if you suffer through the first 15 minutes, which is almost unwatchable, then you actually get into the story that is kind of interesting. And it's interesting, about as interesting as watching an airplane crash or a train wreck or, other degenerate type stories, because that's kind of what this is. Now, with everything, there's winners and losers, and obviously it was a trade, and the stories, was interesting. And, you hear people in there saying this has never happened before and never happened again. Well, of course it's happened before. It happened back in 2000, around the tech crash, it happened, and it will happen again. You have a bottom line. If you remember, it detailed the story of GameStop. It was a Reddit group called Wall Street Bets. You had these outstanding, names that became household names like Roaring Kitty, an individual, Keith Gill, out there who was kind of leading the pack, it seems. And you know what? Everybody's within the right to take to a public forum, use social media. They're not investment advisors like I am, so they can say whatever they want. They can pump, dump, talk good or bad about any stock out there with no consequence, right? We always have, if you're a professional advisor, you have to put every time you have to put a disclaimer in place. Like, I'm not trying to convince you, I'm just trying to educate you, that sort of thing. But yeah, they get out there and, taking it to the man. That's for some reason in America, that's the big thing, is I want to go, take it to the rich people or take it to the government, or somehow I, the little guy, am now moving the needle in life. And that's a very attractive scenario to a lot of people. And you throw that out there, no matter what the particular mechanism is. And it can go viral, if you will. In this case, it did. The stock was heavily manipulated. It was trading and nothing to do with the underlying asset itself, which was obviously a dying brick and mortar, gaming store. But it went crazy, and these people are on, they're getting on CNBC. They're dominating the news. The stock's moving, 50% plus up and down on a day-to-day basis. But really, when you get into what this documentary shows, and again, it doesn't get super high marks there on IMDb. It's kind of why some people need advisors. And I'm not just, shout out because I am one, but you talk about, you hear what some of these people are saying, and they're taking their life savings and putting it on one stock because they knew it was going up, and they're diamond hands, which, means they're not selling. They're, and if nobody sells, then, the stock has to go higher. Well, mathematically true, obviously. To a point, right? But anyhow, this is well into trading, not investing, trading/gambling. And there were some big winners. There's folks walking away with 7 digits. I'm sure there's hundreds, if not thousands, of people that made over $1 million in this bet. But it's a zero-sum game, right? So that means all that money comes from somewhere, like a big poker game, if you will. That, there aren't winners without losers. Right? Long-term investing, though, you invest in the market, companies grow, everybody can win. You get into trading, it's a zero-sum game. So there needs to be an army of losers for a few people to win big, right? So, I hope you watch this with an eye towards maybe degenerate behavior versus this is my strategy to get rich. And they do kind of own that at the end. A couple of folks talk about how they either won or lost big. And they said, you might want to give the old, let's take 20 years to get rich over time. Warren Buffett strategy is how the guy said it, but that, popular strategy, regardless of whether you follow Warren Buffett's particular investment strategy or not. But yeah, play the long-term game versus this stuff. And you're talking about folks not sleeping for days. Some of them say weeks. Obviously that's impossible. But it's really, I don't know, watch it if you're really into this stuff. If you're expecting to be entertained or educated, I don't think either of those two things happen. But like I said, if you enjoy train wrecks and plane crashes and, animal fail videos, this one might be right for you.
Next, with gas prices skyrocketing nationwide, is now the time to invest in oil?
Well, I would say no. Get your time machine out and go back out 6 months, and that would be the time to invest in oil. But if you're going to do that, you might as well short the market while you're at it, because we don't have a time machine that allows us to go back in time. Whenever you see, okay, we're in a situation where you have a crisis in Europe involving, Russia, who's got a lot of oil, then we've got our own inflation going on here in the US, and, all of those things can make oil attractive as oil goes higher. But so it was raging higher for a while. And then, of course, here comes the, the presidential administration saying that, the company shouldn't be profiting as much, on the backs of Americans. And I get that. So, then the stocks kind of come cratering down. So the question becomes, is now a good time to reenter? And I would say no. Excuse me. And here's why. It's like the cigarette companies, and who's investing in that anymore? I mean, I'm sure there still are, but you have a company that's been around forever, and I'm not picking on Chevron, and I'm not promoting it or saying it's bad. I'm just saying it doesn't get my money. I do have some in the book. A lot of people bought Chevron, 25 years ago, and we can't sell it for taxes. So it's not like I don't have money behind Chevron. It's just not my favorite for where to put new money. So the question, the comment was, I wish I had my oil stocks. Is it time to get back in? Okay, no. And that's an opinion. Hey, if you love this stuff and you think it's oil is the key to the future, then do so. I think the better analogy is that it's more akin to tobacco, where we're getting away from it, right? You may have heard that theme, I don't know, beaten to death for the past 10, 20 years, right? And we fought wars in the Middle East for oil. You could argue whether that's true or not. I believe that. And I've got a couple of degrees in military history. And served and fought over there for oil, right? So I mean, you look at a Chevron, it's got a nice dividend. Most of them do. That's 3-4%. The PEs are all attractive, but the problem is this the future? No, it's not. Clean energy is the future. So maybe you make some money in 6 months, or maybe this bounces and you make $10 a share from the ride from 150 to 160. That's trader mentality. That's not long-term investing, right? Where's Chevron going to be in 20 years? I don't know. I think that's a good question. I don't think it's, when you say, where's Apple going to be in 20 years, you're like probably the top of the leaderboard of technology and, handheld devices and computers and things. And if not the top, I mean, nobody lasts forever, but, top 5, right? Chevron may not exist, right? I mean, and people are gonna be like, oh, that's an extremist point of view. Well, there's a lot of momentum to get away from oil, right? Maybe you've noticed that. So I wouldn't get behind this thesis. I would rather get behind a clean energy thesis, even if it's more challenged in the short term. I think clean energy wins out over the long term. So if you're going to get into this space, there are some. I'm not promoting trading, but there are some ways to play it here. Dig and Doug. If you think oil prices are going up, you can go into Dig, which again, these are ETFs designed to trade. Not to hold, but you see it's up 10% today, down 8% this morning. There was a big headline this morning on oil, and then there's Doug, right? So if you think, okay, Steve's saying that the oil is going to go down, I think so. Well, this is an inverse ETF, follows the to the 200% tune. But yeah, it's been beaten up as the oil price has gone up. So I'd much rather enter here and bet against the oil, or bet against what I would call the modern day tobacco, right? I'm not promoting either of those. Those are definitely trades. This has nothing to do with investing over the long-term investor breed stocks and wealth building. But if you're trying to make money on a Wednesday, from this Wednesday to next Wednesday, Doug is I think would be attractive. I'm not doing it, but just throwing it out there as an idea for you.
Last, long-term options are called LEAPS. Can you explain what they are and when to use them?
Sure. So options are literally, I could talk for hours, and I would say, many things. And I do use options. I have options in the book. I have options personally. I have LEAPS in the book, and I have LEAPS personally. However, I sell them. I do not buy them. So the question kind of comes in, and it's can you speak to LEAPS and what you think could work? Well, the nature of the question, not to pick on it, but could work. Well, anything could work, right? I mean, there's I would say the whole Wall Street bets kind of talked about, most people don't factor in the idea of luck into a portfolio. People hopped in or out at the right time in GameStop, nothing more than their good old gut feel, as a stock that's not trading on anything except for just almost a random pattern. And some made, a killing. Now, if they take their money and step away, that's one thing. Like, okay, I got lucky. I realized that. Other people believe they have a system. So, what could work is kind of along the mentality of, and you hear me tell this story on occasion about if you take a football stadium and fill it full of people and have people start flipping coins. Well, if you heads, you stay in the stadium, tails, you leave. And, after 10 flips, there's going to be about 10 to 15 people in the stadium. That's just math, right? I mean, you keep cutting the group in half, and that's math. The problem with the 10 to 15 people that are now down on the field is a lot of the time those people believe they have a system. These are the same people that are, talk about having a system for a casino. The math is against you, right? That's how you build Las Vegas. But yet there's people who think they have a system. So it's like, and that's the scary part, is they'll write books and they believe it and they'll go all in and they'll tell all their friends that they know how to flip a coin better than other people, and all of that's obviously nonsense, because they've not estimated that, flipping 10 heads in a row is actually just luck. Right. So that's kind of where when, the could work mentality, but specifically to the use of LEAPS. So what are they? These are options contracts with a fancy name that are over a year long, and they're up to, generally they're out to 3 years. Sometimes the 3 year isn't available, but I will tell you this. The bottom line for options is you want to be a seller and not a buyer. So in this case, a couple of things were thrown out there. It's like, buy 3 year call LEAPS in Google. It's like, okay, well, if if that's a strategy, that means you think that Google is going to be higher 3 years from now than it is now. I think, yeah, significantly higher. So to buy an option, you're going to pay a premium to do so. So you're going to pay more than it's worth, because that's what the word premium means. And why not just buy the stock? So I say two people use options. People that are gamblers, meaning they just want to have all these parlay bets on the side in addition to their portfolio. Usually that's a fighting boredom, right? So there's gamblers, and then there are people that don't have the capital. If you can't afford to share at Google, because it's at $2,000, and it's about to split here in a little over less than a month. If you don't have the capital, then yeah, you're forced into buying an option or selling an option. But selling an option, so you think of options contracts. It's the ultimate in math when you study derivatives, and you're like, what? He's really bringing up derivatives. Okay, how about an analogy we all use? Fantasy football. Not we all use, but many people use fantasy football. So fantasy football is an entire ecosystem that has absolutely nothing to do with the underlying assets. People play football, teams win or lose. At the end of the season, we have a Super Bowl champion and an MVP, and everybody goes on about their business. Absolutely unharmed, you could argue. Should be unharmed, but nobody should care what people are betting on games, or this entire fantasy football structure where people are creating make-believe teams and competing against each other. And if they have money into their league, you put money in, a bunch of people put money in, generally one person gets money out, or the top three get their money out. That is the options world, right? Why not play the actual game of owning the actual assets versus trying to take some angle on it and lay a big bet? So that's my take. You can use these, sure, could they work? You're going to pay a premium. Anytime you buy an option, you pay a premium. So if you're going to do this, take the other side, right? Sell the option, right? Now, if you're selling a long-term call against Google, I think you're insane. But I would just own Google. I think it's a great company to hold for the long term. make a lot of money, maybe, 10, 20, 30x over a couple decades. If you want to bet against the oil companies, I like that. I agree with you. Let's just use Doug. I think there's other mechanisms to do that, or get in and go short. I do have a short in play now in the book, and we're going to be doing some more of that in the future in specific areas. So overall, how do I specifically use LEAPS? I use them as covered calls and I sell them. So if I have like my own shares of Apple, I've had for a long time, my cost basis is, in the single digits. I've had them forever. And I am not going to sell them. So each time I put an option out there, I'll go out, a month. And then as you have to roll out and up options, not to give you a migraine, but as you manage options, you always have an option on top of the stocks you own. It's like an extra dividend. You can make another % or two in your portfolio by doing this. Now it takes a lot of time, and you just have to manage it. It's literally free money if you do it right. But I don't use that. I use it with some clients that can handle it because they don't ask 1,000 questions. If you ask me 1,000 questions, then it's tough because I have to explain it. I have to answer your question because that's my job. But then my time involved in explaining this to you, it's easier just to sell it and move on, right? So it's making a little bit of money for you, but it's costing me a ton of time, which again, there's a trade-off. I have to do right by all the clients, not just one or two that are invested in these advanced strategies. But certainly for myself, I throw options out there. It's an extra dividend every year that kicks in. Again, I'm selling them. I'm not buying them. I can't say never. I don't see a reason where I would take the buying an option type of the trade. I'd rather be in the casino scenario, they have the expected value, positive expected value. Everybody who walks through the door has a negative expected value. Every seller of an option has a positive expected value. Every buyer has a negative expected value. That's why they pay a premium. So got long-winded there. If you want to use these, I would say don't, but know that there are strategies out there. I like KNG. It's an index fund with dividend aristocrats. And every time you see CBOE, excuse me, that's Chicago Board of Options Exchange. That means that there are people, the managers of these portfolios are using options around the dividend aristocrat to either protect from the downside or make an extra little bit of money on the upside. And when you do that, excuse me, you're going to get a little bit of outperformance. And you're like, really, you're showing this chart and saying outperformance in the same breath? Well, put it next to the market, right? Everything's been beaten up, even the dividend aristocrats, but certainly these hold up better than the overall market. So that's what I've got for this morning, Allison. And thanks everybody for your questions.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.